Chris Mayer, thanks so much for joining us on the podcast.
Hey, Frank, it's always good to talk to you. Good to be on.
It's been a while, man, right?
Yeah, I think it has been a while. I don't think I've talked to you since this whole pandemic hit.
Yeah, it's because you're like a fund manager now, right? I mean, in newsletter day, I had access to you. Now I don't have access to you as much, right? You're a fund manager.
That's right. We're at Woodlock House. That's the thing. It's all different.
Woodlock House. You know what? Let's start there, Chris, because you've been in the newsletter industry all your life. I love your work. Obviously, respect everything that you do, and now you're on the money management side, and it sounds like you're pretty happy about this, right? I mean, how are things going?
Yeah, well, actually, this is my third gig. So my first career was in corporate banking. I did that for about a decade, and then I did the newsletter thing for about 15 years. Yeah, and now I'm on to managing money at Woodlock House, which grew out of work I was doing with the Bonner family office, and the Bonner family seeded the fund. And we opened our doors in January 2019. So, yeah, I like it a lot. It's a lot of fun. It's interesting to do, of course, and really, it's not all that different. I mean, I'm still researching, still talking to a lot of the same people, not traveling because of the pandemic, but it's the same, a lot of the same. In fact, I own some of the names now that I had before, but it's fun.
It's funny you say that too, because you're one of the people. I mean, I always tell you how important it is to, boots on the ground, visiting facilities, visit other countries. I forgot how much you actually do that. So it has to be tough for you, right? I mean, you're on the road like it seems like every other week.
Yeah, I was, and now I haven't been on a plane since March 3rd was the last time I was on a company visit in Milwaukee, and so everything else I've been doing by phone. And it's kind of interesting because I probably talked to more management teams this year than last year, because they're not traveling either. They're available as well. And so I can recall specifically incidents that I have where I've emailed a CFO in the morning and I'm talking to him that afternoon. So everyone's got a little more time, I guess, and this is the preferred way to do things. And yeah, so it has affected me, but I don't know. I'm still getting it done, still getting the work done.
I know, right? It was a fun way to get it done. So,
yeah.
I mean, you mentioned COVID and let's start there, right? Because, we have stimulus coming out, not coming out, but we also already had like $6.5 trillion in it. What are your thoughts on COVID? What do you see next year, say after the election? We have the election and even election. I mean, is that a big risk that you look at, or is it kind of, obviously there's a few sectors, depending on which candidate's going to get elected. And I know you don't want to get political here, but does that, mess with your allocation or how you're looking, until I know you're mostly long-term, but still are you looking at the election as a big factor of who's going to win? And also, what are your thoughts on COVID heading into next year? Is this still going to be a major risk to economic growth?
Yeah, I think you hit on it when you said long term, because I think short term, yeah, it's a risk to create some volatility around the markets and certain names, but I'm not looking at anything saying, well, I want to own this if Trump is president, and I, don't want to own this if Biden's a president, or vice versa. So long term, it hasn't affected what I'm doing. I just don't think it really is going to matter all that much one way or the other. I know people always want to say this election is important. Whatever election is, it's always important. But, you wake up the next day, you're still in the same house, still got the same stuff, you're still doing the same things. It doesn't really change that much. I think people overrate that. And in the long term, over the long term, I don't know that there's much difference when you look at, who the president is. On the pandemic, I think that's maybe more interesting question, because this is something that when it first hit, I was of the opinion that it would be a pretty quick correction, that things would be back to normal relatively soon. I can remember having conversations with people saying, by summer, this will be forgotten, everybody will be traveling again. And that turned out to be dead wrong. And I revised my opinion about a month and a half into it. So I have repositioned the portfolio quite a bit, but I do think that this has and will have permanent effects on some businesses, and that some things are just going to linger for a long time. Thinking about, say, the way restaurants are run, the way hotels do business, the way aviation is just going to be, it's kind of like when we had 9/11, there was the way you traveled before, and then there was the way after. Now people don't who didn't travel before 9/11 forget how security was before then, how easy it was to get in and out and get to your gate. But now it's different, and people just accept it. So I think there'll be a lot of things going forward that will be different with the pandemic, and people, because of the pandemic, and people just adjust. And I don't think this will be the only time that this happens. I've read a number of different research papers on this topic about how we should expect more of these kinds of viruses making leaps from, more of these kinds of things making leaps from animals to humans and wreaking havoc. So I think it's a new risk to underwrite. That's why I've told my partners it's something that, even though I've been in the business for 25 years investing, I've never had to invest through a pandemic. And now I have a new risk. So it's something I think about. How is this business going to perform if there's lockdowns or if there's, social distancing or whatever?
Because I like the way you put it in terms of airlines. Like, people did forget, so I think we're almost, I don't know when it changed so much. I don't know if it's social media. It's all like an all or none, right? Yes or no world where, it's not that flying is not going to exist after September, but it's certainly changed. I mean, to the point, you're right. I mean, you can go on and strap a pound of marijuana, we'll put it underneath your shirt, and they'll be like, "Yeah, get right on."
Yeah.
Now, forget it. They're probing you. It's crazy.
Right.
So,
and I remember, even traveling in Asia, and you've done this as well, wearing masks is more common over there. You just see it. Someone's sick, they wear a mask, or they, there's a it's different over there about it. And maybe something like that will be more common over here.
No, it definitely makes sense. So I want to get into. I think a lot of people were looking at as a value guy, and so many deep value managers. We do know deep value has been out of favor, or at least deep value names with little growth catalysts. But can you explain how it's important to even with your methodology? I've always noticed that, you're able to adapt to current conditions because, I've seen you recommend a lot of growth companies, even on this podcast. And a lot of those times that they're under the radar, even under my radar, which is pretty cool. I love to hear those ideas, but how important it is to adapt to the markets, even if it means going against a style of investing that you may have spent decades learning.
Yeah, you have to, you definitely have to adapt. I mean, otherwise the market just carries you out. So I know a lot of value guys who haven't been able to adjust to the new world and who still think things are cheap because they trade at 10 times earnings or less, and don't seem to really understand that the amount of capital required to generate those earnings is a big factor. And the capital light businesses are more valued than ones that require a lot of reinvestment. And there's other, these other little aspects that create value. So, yeah, you have to adapt. It's important to adapt. You have some core principles of things that you will always stick to. And those core principles for me are things like, how I always talk about the importance of having good owners and proper incentives. Those things stick no matter what. I've always been a guy who invests with strong balance sheets, companies that are in good financial position, don't have a lot of debt, and that's something that sticks too. I don't do that. But there are some things that you do have to change. I mean, think of all of the way markets have changed just in the last decade. You have passive, which has been dramatically bigger part of the game, but probably bigger and more important than that are interest rates coming down so low. And that changes the game too. I mean, you have to adjust now. Something that trades at 25 times free cash flow, that's a good business that's growing and has good returns on capital. That's probably a pretty good price these days. Dare I say even cheap. But that's something that would have been crazy to say, a decade ago, when treasuries were 4 or 5 or whatever. So you definitely you have to factor in the rates. That's one big thing.
Yeah, and I could tell you, I think it was from, let me see, it might have been Jefferies, I think. Someone did a really cool report just showing like the highest growth names and what they have in common to the rest of the market. They have the lowest debt levels. They're growing much, much more faster than the overall market. I mean,
Right.
Good management teams. I mean, this isn't like the tech bubble days where, you had 5 pages to your website, you had $1 billion valuation. I mean, these guys are seeing tremendous growth. It's sometimes very, like, I don't know how you price it with Zoom and Peloton and things like that, but apparently as long as you're really growing a lot faster and bigger numbers, that's what the market wants to see. And it's important to make sure, I would think that, any new recommendation or something that you're buying has some kind of growth catalyst or growth component to it, right?
Yeah, I mean, I think also, I remember seeing an interview with Andy Suror, who interviewed Warren Buffett earlier in the year, and he asked Buffett if he thought the FANG bubble would pop and if those companies would come back. And Buffett said, no, quite the opposite. He said that those companies, their lead would widen. And that's because he pointed out that they don't require any capital. They don't really, they can continue to grow practically with very little capital or no capital. Maybe not Netflix, but the others, Facebook, certainly Microsoft and so on, Google. And so, that's an interesting moment. So he sees it. And, the big challenge today with investing is there's a lot of these kinds of companies. You mentioned Peloton. There's a lot of these kind of companies that are coming on that have these potentially big markets growing very fast, but maybe, the economics are not quite as clear. And, that's harder for me to play in that space where the company doesn't necessarily have good cash flows today or generate good returns on capital today, but they're investing a lot and it's more of a forward story and the valuation's so high, but there's a sweet spot in the middle. There's some very interesting growth stocks that I was able to buy and still get, 4 or 5% free cash flow yield, or 3, or even down to 3, but they're growing very quickly. They have great balance sheets, great managers. And I think over a period of time, you'll do well in those names. You have to remember too, that good businesses have a way of surprising you. One example I like to talk about or like to bring up with people is Amazon. When you think about it, started out selling books. That's it. That's what they did. And I remember seeing all kinds of analysts who would write reports saying, well, look how overpriced Amazon is. Even if they captured the entire book industry, the stock's still expensive. But obviously what people couldn't see is that they created entire new businesses, new markets. I mean, now AWS is one of the largest software companies in the world. That's embedded within Amazon. So you look at Apple, and they've created entirely new markets over the time. So good businesses can surprise you in that way.
Even Netflix. Remember they used to mail you movies?
Oh, that's right. Yeah, that's right. Netflix is another great example. Look at that. Look how they've transitioned. If you could have gone back and seen how they would evolve. I mean, it's amazing.
Yeah, it is pretty incredible. So we talked about this earlier when it comes to investing globally. And for you, you're one of the people I listen to the most when it comes to global investing because you do so much traveling, which you said, you're not really doing as much, but at least you're able to contact a lot of people, through Zooms and Skypes and things like that. But we're all seeing massive stimulus plans from most central governments. Looking at COVID, the death rate as a percentage is heading lower in lots of regions. Is there any specific country or countries you're looking at that offer, great value to investors, which a lot of them are trading at a good value, but also have that growth potential?
I don't know. I think about it quite that way, where I would think about it as a country as a whole. I mean, if I look at my portfolio now, the biggest holding I have is listed in the UK, but it's not like necessarily I see the UK, as a country having a lot of growth, et cetera. But this particular business has a lot of potential there. I also have a business listed in Italy and in France, but they're more, international operations. So I think there's a lot of interesting things to poke around in Western Europe, and that's a market I like because the disclosures are often pretty good, and everything's in English, and so that's not as much a culture shock to invest there. But I would love to find something great to invest in say, I don't know, India, but it's difficult,
Yeah, it is definitely difficult. So I'm gonna put some pressure on you here because every time I introduce you, I'm like, Chris always gives us these under the radar names that a lot of people never heard of or whatever. So I don't know if you have any of them, but
yeah.
And I know you love sharing some of your ideas, but
sure.
If it's not under the radar names or what trends that you're following or
right. Well, I could give one under radar name perhaps. Well, it's on my mind this morning because Devon Energy said they're going to buy WPX. It's kind of a big push in the Permian Basin in Texas, and this follows on another deal too. I forget. I think it was ConocoPhillips talks to buy Concho Resources also in the shale. So oil is not very popular right now, and oil's come way down. But the Permian Basin has some of the lowest costs in the country, and there's a company that I like, that I own there, called Texas Pacific Land Trust, and they have it's just a royalty play on the oil and gas. They own the land, so companies come and drill there, and they get a little piece off the top. And the economics of doing that are really, really high. I mean, their return on capital in some years pushes 100%. It's extremely cash generative type business. They have no debt, and so I really like that. It's come down a whole bunch. It's cheap now. They also have a water business, so not only they get a cut of the oil that comes out of their land, they also help with. They also provide water and then recycle that water and sell it back again. And so that's a really interesting one. And there's also some movement now going on with the company's converting from a trust to a C Corp, and that will happen some point in the fourth quarter. That'll be a nice catalyst. There's activists involved led by Horizon Kinetics, which owns a quarter of the stock. And I think what you'll see then when they convert, you'll see better disclosures. You'll see a big buyback announced, I'm sure. And I think that one's a nice one to hold long term, because at some point the situation will look better for oil, whether it's next year or the year after. But in the meantime, you own a debt-free company that throws off a lot of cash and has tremendous economics. And if oil should ever go up again, this thing will multi-bag from here. So that's one I think that's and of course, full disclosure, we have it in the fund, so I own it, and I like that one.
So it's funny because Texas Pacific Land Trust, my late dad, it was one of a recommendation that he's followed for probably 30, 35 years. Very familiar with the story, like the whole entire thing. I'm going to say his research on it because it's pretty incredible. He's recommending the single digits, and I think my mom still owns shares. She still owns shares of that from 30 years ago. But just it was a self-liquidating trust. It's from the railroads put together. They went bankrupt and had to pay their owners. So basically, all the money they generated from royalties, they basically had to buy back the stock. So it was like 2 million shares outstanding, but. To see where that company went, I think it was in $800 range or whatever. I know it's pulled back, but yeah, that's a name that's dear to my heart, because I still get people who followed my dad for a long time ago. Older investors always say, "Land trust, you still own."
Yeah.
It is a fantastic story. I gotta send you the research though. It's pretty cool to see the research back then.
Yeah, that's cool.
Awesome.
Yeah, I think that's an interesting one. And it seems like it's hard to screw it up, right?
Yeah, especially at this point. You're right.
I mean, there are other
Mm-hmm.
interesting things to own that I think, if you've got a long-term focus and you're counter-cyclical and you want to invest, in some of the things that have had a tough year now, I think, I always like a company called Exor, lists in Italy. It's also, there's a pink sheet in the U.S. you can own. Exor, EXOR is the name of the company, and it owns, among other things, it owns Ferrari, which is a great business, and then it has a reinsurer, and it owns a piece of Fiat Chrysler and CNH Global. But anyway, you add up the market value of its holdings, and stock's probably 75 or so euros, and the Exor trades for around 47, 48. So you get a very good discount there. And John Elkann, who is the CEO, he is one of the better capital allocators around, in my opinion. The Agnelli family owns half the stock, and they just announced buybacks. So that's another one. I think downside's pretty low, and you've got really nice upside there if things, bound back to normal. So there's a couple of perhaps under the radar names that I like that maybe your listeners will find interesting.
Yeah, no, definitely, definitely. That's definitely under the radar. So that's cool. And yeah, they like the pink sheets too, because it's not that easy to buy stocks, in Italy. But
Right.
all right. So, Chris, if someone wants to learn more about you, because I asked you that question now. I was like, how before we actually got on, and you told
Yeah.
me, to Woodlock House. But I noticed that you have a blog on there, right? Which is cool.
Yeah. Yeah. So I write a blog. I try to put something out every other week. But yeah, I mean, if you just Google Woodlock House, it comes right up, Woodlock House Family Capital, and you'll find the blog. And so what I write there, I write about sometimes names I own, sometimes names I'm looking at, and I share some research that I'm doing. Last time, for example, I talked to the treasurer of Old Dominion Freight, and I wrote some notes from that on the blog. And then I'll write about books or other interesting ideas that come up. So yeah, people can find me there. I'm also on Twitter at Chris W Mayer Mayer. Those are two ways to find me there.
No, it's great stuff, and I love that because usually when I'm interviewing someone, I'll take like a half a day to read everything they wrote over the past few months, and I'm like, Chris, where are you?
Yeah, yeah,
And you're like, let's just freestyle. I'm like, okay, we're good at this. We could just freestyle and go into everything. But
yeah,
no,
yeah,
it's see that like a lot of this stuff is and that's what woodlockhousefamilycapital.com, but you just
yeah,
put in
yeah.
Woodlock House.
Or yeah, you can just Google Woodlock House and Woodlock. My Woodlock House comes up first. So and you can find the blog there. Yeah, I've written about. Last time I wrote about sort of the scarcity of industrial land. There are a couple companies that have locked down land close to big cities. It's very hard to replicate. And a couple weeks before that, I wrote a piece on the big picture, talking more about interest rates, and I've had other little profiles of companies and ideas before that. So it's fun to write, and I just sort of write it when I feel like I have something interesting to say. But it usually comes out about once every other week.
No, it's great stuff, Chris. And listen, I love having you on. I got to get you back on more often because, again, I always love your ideas. I respect you as an analyst. I think you're fantastic. I always learn something when I talk to you. So I really appreciate you coming on, man. I really do.
Sure, man. It's fun. Always talking to you. And yeah, we'll have to do it again.
Sounds good, man.
After these ideas, play out well and double, then you can have me back on.
Yeah, if they go down, I'm gonna have you back on.
That's right.
But that's great stuff. So, Chris, yeah, thanks for being on, and yeah, we'll have you back soon.
Take care.